Hi, everyone. Well, thanks for joining. As most of you know, we've been doing these webinars every week or so throughout the kind of COVID-19 period. The basic aim of helping as many clients and non-clients as possible, with the situation from a legal perspective. We've also been getting eminent business people in to give us their views on, their specific area of expertise. And today we've got James Cameron, partner at AirTree, who is really going to be here to kind of talk about the sorts of things startups can be doing in this COVID-19 era, and give us some tips on what AirTree's portfolio companies are doing, on what all types of startups should be thinking about in terms of their metrics and so on and so forth. I'll let James introduce himself, and then we'll take it from there with some questions.
Nice. Well, thank you, Lachie, for the intro. Lachie and I go back a long way. I used to work together as a lawyer with Lachlan years and years ago when we were both in London. So he was the much better lawyer, and so stuck to his guns. I was desperate to find a way out of the law, and wound up.
I'm sure about that. I'm pretty much a failed lawyer as well, so you know.
I was going to say that, but I didn't want to with all the clients on all your clients. You're a much better entrepreneur than you are a lawyer, I should think. And hopefully I'm a better VC than I ever was a lawyer, because I wasn't a very good lawyer either. But I've been here at AirTree now about 3 years. We've got a team of about 16 people here, but before I joined the team at AirTree, I was a VC overseas. I used to live in London, and I worked for a US fund called Accel. And before that, I used to live in the States and ran a fintech startup. And before that, I was a lawyer with Lachie in London. So I've sort of bounced around a fair bit. But when I was at Accel, we looked at startups all over the world, and one of the areas we had a huge amount of success was investing in Australia. So we would fly out every year at least, probably twice a year, looking at companies down here, and we made a bunch of big bets on companies like Atlassian and Xero in New Zealand, and Campaign Monitor and Invoice to Go and 99 Designs. About 6 or 7 big investments that we made while I was at Accel. And so it was really nice to be able to see the really sort of the ground zero of this most recent generation of startups coming out of Australia. Of course, I was looking at it from a growth investor's perspective from overseas, and as an Aussie, I was keen to come back to Australia and get back to doing some more early stage stuff down here. So eventually, I convinced my wife to move out. She's a Brit, so it took a long time, but she eventually agreed, and we moved back out to Australia, and I joined up with the team at AirTree, and we look at everything, really, everything within the technology space. We're agnostic as to sectors. We'll back companies in fintech, in edtech, in healthcare, in software, basically the whole gamut. I think that the thread that probably brings it all together is we're trying to find founders who are looking to build very large businesses, not necessarily global. Some are Australian only, but they are all looking at building something that has a very big impact and can build a big business around. And we invest. And
what's the number there? Like, revenue-wise, how much revenue do you need to be aiming for to be aiming for something big in your kind of, view of the world?
The last couple of years, we've seen multi-billion-dollar exits on no revenue, so it's not necessarily tied to that. But it depends where you're looking at. If you're looking at a software company, for us, we're a $275, $300 million fund, and so for us to make a dent in the fund, we have to be looking to return, probably 200 million or so, not quite the whole fund, but off the back of that, if you assume that we own, 20% of the business, it's $1 billion exit. And on, pre-COVID revenue multiples for an enterprise business, that's a $80 to $120 million revenue line. So it's pretty big. Obviously, a lot of the companies we invest in don't get there. In fact, most don't get there. That's the whole model around venture capital, right? It's a hits-driven business, and so we have to invest in companies that have the possibility to get there and the possibility to make a real impact. And we invest early, and so as a result, many don't, and we do everything we can to help them get there. But we invest from seed through to growth stage. So a lot of the companies we invest in are pre-revenues. About a third of the companies we invested in the last 2 years have been pre-revenue, and some of them are pre-product, and in some cases pre-company, and that's when we send them to Lachlan to go and get their incorporation documents done before we can actually invest in them. So we do go in early, and we have about 700 million under management at the moment across our 3 funds. We invest primarily in Aussie and Kiwi businesses, or businesses that have some nexus. So we invest in quite a lot in Aussie and Kiwi founders that happen to be overseas, or in some cases companies that have an Australian offices but are headquartered overseas. So it's pretty broad. It's a lot of fun.
Good. All right, that's a good intro. So let's get into the kind of I guess COVID-19 conversation. Obviously, I guess probably kind of mid-March, things changed a lot in terms of the broader economy. Obviously in particular hospitality businesses, but basically businesses across the economy, were very significantly affected by the government, mandated shutdown. It's likely that we'll see, across the economy, lots of sectors really struggling over the next, good period of time. So, how do you kind of deal with that in the startup investing space? When you start, has it changed the way you're looking at businesses? Are you kind of more long term, so it's not a big issue? How has it changed the way you're looking at companies?
Yeah, well, I think you nailed it. I mean, we are long-term investors. We have 10-year plus fund cycles, and so we invest on companies for anywhere between 5 and 12 years. Really, is our investment horizon. So for us, sort of a 2-year downturn does not have a huge impact on the thesis that we have coming into these businesses when we invest early. We try and invest in companies that are structurally advantaged for what's going to happen in 5 years' time or 10 years' time, not what's going to happen in 6 months' time. So to that extent, I think technology investors across the board are in a fairly fortunate position. A lot of the businesses that we invest in are shipping bits around the world, so I don't have as many direct relationship with the sort of physical economy. I look at some of my peers who are investors in private equity funds, for example, who have portfolios that are much more heavily integrated into the domestic economy, in particular hospitality and travel and the like. And I think they've been more hard hit than a lot of the technology investors out there. That's not to say that tech has had it easy. A lot of tech founders out there have really been hit hard. And across our portfolio, I think you sort of see 3 buckets emerging. You see companies that are focused on sort of hospitality or fashion, or selling into those retail, or selling into those sort of customer bases that have had their demand sort of evaporate overnight. And for those companies, it's really been a question of what can we do to really put the brakes on and consolidate what we have built and effectively go into hibernation for 12 months potentially more, and come back out of the back and really just hold on to our runway. And for those companies, they had to make those changes immediately overnight. And then there's another group of companies that have had a real tailwind, and we've seen that immediately for any of our companies that are in e-commerce, for example, a lot of digital healthcare businesses. So companies like Pet Circle, which is selling subscription pet food. They're up a huge amount based on the year-on-year growth rates from last year. Canva, weirdly, is doing exactly the same. They're posting much stronger numbers now than they were ever, and they've been growing really quickly regardless. I think that just a lot of people are at home designing all sorts of things. So I think they've had a nice little tailwind. The online education sector, companies like a Cloud Guru, which is doing developer training, and Secure Code Warrior, which is doing training for cybersecurity specialists. Those companies have had a huge tailwind as people are forced to start to think about retraining, reskilling, and online training is their only option. So I think there's that bucket that's had a real tailwind, and had for them, at least in their revenue line, COVID is the best thing that's ever happened to them. And then there's this big bucket in the middle, which is, in some cases, it's a lot of the enterprise software companies. It's a lot of the companies who are selling to sort of mid-market businesses. And for them, they were in this weird spot because they got to the end of Q1 and for the most part, they hit their numbers. They hadn't seen an impact. They saw the world sort of falling apart around them, but they hadn't really seen it impact their pipeline or their sales numbers. And so they got through the end of Q1 and they were sort of looking around, almost patting themselves on the back. And I actually think those are probably the ones that are the trickiest, because you can have this real false sense of security in that the crisis sort of takes a lot longer to hit some of these larger enterprises in your customer base. It will hit them, it absolutely will. I mean, if the broader economy and employment drops and GDP drops, those companies all get hit and they all tighten their belt. But it was taking longer to hit the procurement offices and to hit their sales cycles. And so for those companies that weren't seeing an immediate hit to their revenues, in many cases there was less of an incentive to suddenly, start thinking about rewriting your execution plan and building out scenario analysis and extending your runway, where in actual fact that's exactly what they should have been doing. And so we've spent a lot of the time in the last 2 months working right across the portfolio, helping companies put in place new plans to execute on and focus on extending runway for those that have been hit immediately and for the ones that we think will be hit.
Okay. And what are the sort of broad brush strategies that you're advising portfolio companies to take in order to extend their runway? I mean, is it cost cutting? Is it what is it?
Yeah, I think the first decision when you come into this sort of period is always, how do I extend my cash runway? How do I, if I was out there fundraising, how do I accelerate that? If I've got 12 months cash runway, how do I extend that to 18 months or possibly 24 months? I think that's the first set of decisions, and being able to sit down and put together a scenario analysis that sits down and works out what are the external potential outcomes at the broader economy level. And then what are the various things that we can do internally to prepare for this? And the best companies that I've worked with that are doing this in the portfolio have a very detailed set of scenarios, sort of a matrix style scenario analysis that sets out the various situations that they may find themselves 6 months down the track in terms of what the economy is doing, and have for each of those a potential plan of action in terms of cost cutting, reductions, reduction in marketing spend, etc. And in many cases, we've seen for those companies that they're actually in sort of the top right-hand corner, or sort of the better scenarios now that we're sort of 2 or 3 months in than they thought they might be. I think certainly those who are selling to Australian customers, I think have felt less pain, obviously, because we've done quite well on the health outcomes. But I think even in the ones that are selling overseas, they've been surprised on the upside. But putting those plans in place immediately and really sort of going through the active planning was hugely beneficial for all the companies, even though the actual forecasts themselves don't mean much. Like the numbers that you get out the end of it at the back of those spreadsheets when you're doing your forecasting scenario analysis, it's really, really hard to have any confidence in this sort of period. And I think we've seen, I mean, if the government can't get JobKeeper right by $60 billion, then what hope is a startup that's just on the beginning of its journey? So I think give yourself a bit of a break when it comes to the actual numbers, but the act of planning and going through that thought process is incredibly important.
And certainly, I think a number of companies are probably finding areas of expenditure that seemed like fine pre-March, and now they're kind of going, is this really necessary? If it's not core to what you're doing, there's always opportunity to save cash. And then I guess the question then is, are you seeing many of your portfolio companies actually double down on marketing and sales in the current environment, given the fact that certainly in terms of online digital marketing, pretty much across the board, CPCs have gone down, cost to acquire is getting cheaper. You're seeing people kind of use that situation, or?
Yeah, we are. I mean, all of the B2C companies in the portfolio most of them are doing better than they were pre-COVID because they're structurally advantaged. They're largely e-commerce or they're tech enabled, and so they're finding themselves able to take share from sort of non-tech enabled incumbents. And the reason and the way they're able to do that is a lot of the incumbents are pulling back quite heavily on their marketing spend. Now, CACs are going down. The conversions are also going down, to be fair. So it is a little for most of our portfolio companies. So you really do have to focus on your overall unit economics. Most of the the best builders in our portfolio knew their unit economics back to front, and so as soon as they see opportunities where a combination of conversion staying reasonably steady and CAC dropping, they knew exactly where they could bid into in terms of direct acquisition. And so a lot of them have been very aggressive in that, but that's because they know exactly what their CAC payback cycle is going to be like. And the ones where it's dangerous is you've got no idea what your CAC payback is going to be like, and you're focused on this sort of nebulous concept of lifetime value for customers when you're an early stage company and you don't really know what that is, and you start investing and reducing your runway for an uncertain return. That's really dangerous, I think, in this part of the cycle.
Yeah, no, for sure. And I guess the conversion side of things is probably because you've got a whole bunch of people sat at home, cruising the internet, getting into to carts and not buying, and it makes sense. But I guess that does make it easier for a more developed for a startup that's been going for a longer period of time that actually has a good understanding of the unit economics, as opposed to an earlier stage startup that's still trying to work that sort of thing out. I mean, the data you get in this period is not going to be necessarily the data that you'll see in a year's time, if that makes sense.
Yeah, exactly right. And I actually think that the B2C, or at least the companies selling to SMB market, they've got a little bit more of an advantage here in that they have much faster feedback loops in terms of their marketing cycles. They can understand exactly what they're pushing out and how quickly that's returning. For the enterprise software companies selling sort of mid-market and above, you've got to be a lot more creative with how you sort of look at the impact that COVID's had. And I think we've pushed a lot of our companies to become a lot more active in terms of their sales operations and their discussions with procurement officers of their customer base, because really that's the best leading indicator you've got around softness in your pipeline, is to really have a conversation with all the procurement officers at your potential customers in your pipeline and understand if anything's changed in their procurement processes. If there's new if there's new requirements that force them to escalate purchase decisions up, whereas they didn't before, if there's new caps, if they're asking people to run longer trials, all that sort of stuff. So have a genuine and honest conversation with your pipeline and try to understand exactly how if there's any softening in your pipeline, or if there's going to be any likely extension of your sales cycle. Because otherwise you just don't know. You can sit there 2 quarters in and suddenly your pipeline could dry up and you won't have had any real indicator based on your revenue growth. Yeah,
interesting. So, obviously, if you're doing well in the current environment, great. If revenue is an issue, so you've seen a dip and you're a promising startup, but cash is going to be an issue in the next kind of year or so, and you can't really extend your runway because for whatever reason, the decision then is normally to go out and raise, right? What are you seeing on I guess the number of startups approaching you, on the number of deals being done? What's happening on the kind of fundraising front in VC world?
Yeah, I think this is largely anecdotal at the moment because there's way too early. The Australian market is pretty young anyway, so even the aggregated numbers in the best of times don't really tell much of the story of what's going underneath. And at the moment we're only a few months into this, so everything is anecdotal. So we're still investing heavily. In fact, if anything, we've sped up. We've got 2 term sheets out at the moment. We've just closed 2 investments in the last 2 weeks. So and not intentionally speeding up because of COVID. It's just idiosyncratic, and that's the way that our investment pipeline has gone over the last 2 months.
Are those investments public, by the way?
One is we invested in a company called Archistar, which came out announced 3 weeks ago.
And what do they do, just out of interest for the attendees might be interested in?
They're a platform based here in Australia that do automated generative design for architecture, for buildings. So if you're a property developer and you're looking at a series of different potential lots of land, and you want to have some ideas around what you can develop within all the local requirements, this can auto-generate a whole bunch of different designs, which you can then sort of build upon and make sure that you're happy with. And it's a new sort of emerging field around AI-based design generation, and a really smart team of architects who have sort of built a lot of the playbooks. A bunch of PhDs have built the playbooks in that, and are quite renowned for it. So we're really excited about it.
So that seems like an example of kind of not really worrying too much about the kind of COVID-19 immediate economic effect, because the reality is it's probably not going to be good for the property market over the next couple of years. But you're not worried about that because you're investing on a longer kind of term horizon.
Not at all. Exactly right. I mean, these guys are revenue generating, and they've actually accelerated through COVID, but not because of COVID. It just happens to be that they have, having a small number of customer conversations at any one time, and the product saves their customer base a lot of time and effort and money. And so the value proposition is. I think that's a good broad point to make. I mean, the opportunities for startups coming out the back of this this crisis are really fantastic. I mean, we are seeing across the board a move towards digitalization of the economy that has huge benefits for startups who are in any way tech enabled. And that's just the sort of the macro tech adoption level. On the broader point, which is we're in this situation of immense uncertainty, startup founders tend to operate pretty well under uncertainty. That whole concept of was it anti-fragility, that Nicholas Taleb concept, and I actually really don't like the guy personally at all, but the concept that I do agree with is this concept around anti-fragile, and that there are some organizations and some people that do react well in times of high pressure and actually makes them a lot stronger. And I think founders tend to fall into that bucket. And so all else being equal, I would back a strong founder to come out of the back of a crisis like this with more momentum relative to an incumbent going through the same process. There's one big caveat to that, of course, and that's cash runway. Startups don't have the balance sheets that their incumbents do. And so if you control for cash runway, I would bet on a startup every time. The big challenge, of course, is making sure you've got that runway and making sure you can access that. And that's the challenge now. Back to your original question, is what happens in VC financing. So I think at the moment, anecdotally, things are happening largely business as usual. I think that you'll continue to see a lot of the big funds in Australia continue to invest all the way through this period. And there's going to be a lot of great startups that are started in this period. So there's a lot of great seed deals to be done. We've seen the same thing happen in GFC. We've seen the same thing happen in the dot-com crisis. A lot of the best companies to have come out of Australia have been founded in both of those downturns. So there will be great opportunities to invest. I do think there's probably a lot of people out there sort of thinking to themselves, oh, all these VCs saying they're still investing, it's business as usual, but I can't get in people's calendars, and it's hard to get engagement. I do think there is a sort of difference between intent and reality sometimes, and I certainly think in the last 2 months, I think there's just been so much going on across the board that a lot of VCs, including myself, have had less time to focus on new deal origination work, which is usually, if I take a look at my day, it's, I usually spend about, probably 10% on internal AirTree stuff, probably 40% on the portfolio, board meetings and working with my founders, and then probably the 50% on new deal flow. I think in the last 2 months, it's still been about 10% on internal stuff, but that portfolio work, sort of working with our founders and making sure they've got the right plans to execute on, that's probably jumped up to 60% of my time. which meant the sort of the new deal origination work has dropped to 30%. And then on top of that, life has happened. I'm sort of dealing with childcare and being at home, etc. So I think my overall time that I had to dedicate to work has probably dropped by 20-30% again. So both of those factors have sort of narrowed the amount of time that I actually have to take new meetings and meet founders. And so it feels as though we're coming out the back end of that, but I do think that that does sort of explain some of the differences between intent and reality that I'm sure a lot of founders out there see.
Sure, and then there's the reality that a lot of startups are not investable in any way, shape, or form, and that doesn't get talked about too much by the VC community necessarily, because you want people to kind of reach out. But certainly, we work with stacks of new businesses, shall we say, and many of them are just not businesses that the VC would or really should be interested in investing in, and nor should that business want VC investment. And so I think there's also that kind of reality that I guess people need to be a bit more realistic about their business. But
I think it's I mean, the VC industry as a whole is pretty loud. We tend to tweet a lot and do webinars and things, but that's we're still a tiny fraction of the overall funding sources for any business, but including startups. And so I think that's a really good point. I think there are a lot of businesses out there that VC just doesn't make sense for, and should be looking at other ways to do it. In fact, Australia's got a very proud history of great bootstrap business that have become very, very large in some cases, and long may it continue, because I think it's a terrific way to build a business.
Yeah. All right, so just everyone who's listening in, we'll move to questions now. If you've got questions, just stick them in the question kind of chat section or whatever it is on GoToWebinar. We've got a few that people have sent through beforehand, but if you start putting in questions, we'll kind of jump into the ones we've got that have been sent through beforehand, and a couple of good ones. I think this is a good one, interesting kind of way of putting it as well. How can we best defend a company's pre-COVID valuation going into a capital raising mode during the COVID-19 and onwards? So, I guess broadly the question is, I had this valuation maybe in mind, or maybe I've been discussing it with investors, and how do I kind of, maintain that going forwards?
Yeah, well, I mean, I think there's two answers to that. I mean, I think if you've had a valuation that you've agreed pre-COVID and you just happen to be closing it in COVID, I think you've got a very good argument to your investors to keep that. And certainly that's the case that we saw with all our deals, and I haven't seen many deals in the Australian market that have been repriced as a result of COVID. But that's just a narrow set where you were doing your fundraise and you were close to the pointy end of it coming into COVID. I think there's a broader question. I think in an environment like this, there are companies that are still raising on the same valuations that they always have and have always been able to maintain in terms of revenue multiples. And I think for those companies, there's probably just a narrower set of them. As some of the venture dollars have started to pull back a little bit, there's probably a fewer number of companies that are able to reach those very, very high sort of 30x plus on annualized revenue multiples for software companies, for example. And so I think for everybody else, there has been a pullback. I don't think we've seen it a lot in Australia yet, but again, we just haven't seen that much. There's not enough deal flow to really aggregate data very well in Australia. I think anecdotally in the US, we saw a pretty quick pullback, sort of 20-30% on valuations, which meant that in many cases, companies that needed money soon were looking at doing down rounds. I think that the benefit that a lot of companies have, though, is that even with the public markets pulling back 30%, if you would assume that private company valuations came down by 20-30% at the same time, then if you are a company that's growing 100% year on year and you raised last year, you're still facing an up round, even if your revenue multiple is pulled back by 30%. And so you can still largely avoid. You may not be getting the same revenue multiple, but you should still be able to get yourself in an up round. And I think that's what people are desperate to avoid, is sort of damaging down rounds. And we've seen down rounds happen. Certainly, I think there's been there's been some very high profile ones coming out of the US. The ones I think that have done it well are the ones where you've had a realization that the down round is really outside of the control of the founders. And so in a lot of cases, I've seen down rounds where there's been concerted action on the part of the shareholders to actually make, or at least remove some of the dilution effect on the founders themselves as a result of that down round. So giving ESOP top-ups or management carve-outs and things like that. There are definitely mechanisms that you can put to work to make sure that you're properly incentivized, because the worst thing, what your shareholders absolutely don't want to do is wind up in a situation where the founding team is not incentivized to build the business out of this crisis. The opportunity is going to be on the other side of this crisis, and you really want all of your founding teams to feel like they are core owners in their business. As soon as they start to feel like they're employees in their own business, then there's complete misalignment between the cap table, and so that's a disastrous situation. No sophisticated investor is ever going to want that. So that's the best argument that you have to sort of settle in, to justify at least a sort of flat round or an up round to make sure that you are aligned.
I mean, if you're sort of at an earlier stage though, and you maybe pre those kind of VC conversations, or you haven't kind of for whatever reason you haven't got VCs investing, and you're dealing with sort of angel investors. I think it's fair to say that angel investors have probably been more scared off, by COVID-19 than VCs. I don't know. Have you kind of seen any evidence of that?
Yeah, I think the three deals that we've just done have all had angels in them. So I think there's, but again, it's all anecdotal. I think there's definitely angels that I've spoken to that are just sitting on their money, and then there's definitely angels that I'm speaking to that have had their net worth, drop by 30% almost overnight, and so are clearly not, they're sitting on a lot less money and have very little appetite to. So I think that is an absolute impact. That is always a risk with angels across the board. And for companies in that situation, I think that the good thing you have going for you when you're in a very early stage is that you don't have a huge cash burn, and so shaving money off and doing it on a lower burn and really going into sort of core unit economic profitability for a short period of time is more achievable than if you're a Series C startup who's burning $2 million a year and have been at growth at all costs for the last 18 months. Those companies, they hit the wall, and it really is painful. For a company that's sort of pre-revenue and only a handful of people, it's much easier to sort of ratchet down a little bit, drop down to paying people 4 days a week and sort of bumble your way through, knowing that on the other side of this, you should be in a structurally advantageous position to really slingshot out the other side. So my advice to a lot of companies who just can't raise that really first friends and family around at the moment is, keep plugging away to the extent you can, keep building through this, because you should be in a position that is really strong at the other end of this, especially in Australia where we're seeing much less of an impact on the health outcomes. Yeah,
that makes sense. Maybe not something you've had to deal with over the last kind of couple of months, but it's worth kind of discussing. Do you have any advice for boards around managing liquidity or solvency issues?
Liquidity for shareholders, you mean, or solvency for the business?
No, so I assume what we're talking about here is like solvency in the company, or cash liquidity.
Yeah, fortunately we haven't had to deal with it. Certainly, we have in the past, but not as a result of COVID yet. Fingers crossed. And so I think the first question is, if you're on a board and you're worried about that, you should be talking pretty openly with your other board members and looking at all the various options that you have, because it's tricky ground, and you don't want to be on the wrong side of insolvency law. So talk to your lawyers. In my experience, there's been lots more leeway for companies going through difficult times now when it comes to insolvency safe harbors. And so taking the right advice and making sure you've got a good view as to where the risks are and where you have leeway, I think is very important. And you'd probably be surprised, you probably have more leeway than you think in terms of the insolvency safe harbors. But listen, there's absolutely no question that there's going to be a lot of businesses that are there. I think JobKeeper at the moment has been such a massive relief for companies that are able to participate in it, and I know that's absolutely not the case. That it's not every startup out there. There's a lot of pre-revenue startups that haven't been able to take advantage of it, but for the ones that have, I think that's been a real lifeline. And there's been some discussion as early as I think today around potential extensions for it. So I think that will continue to be of huge help. We're also spending a lot of time with the government trying to lobby on Startup Oz's behalf to try and improve the R&D tax credit setups. As you know, we've been doing that for a long time, but specifically around COVID, where we're trying to get to a position where companies might be able to pull forward their claims for next year, which would be another huge boost. And there are a lot of other government grants outside the JobKeeper that are available and tax concessions. So working your way through with your advisors and your accountants, and we've got sort of links up on our website to all of the things that we've suggested to our companies. There are a lot of things you can sort of scramble together to try and make ends meet.
Okay, good. Hey, we've got a couple of more sort of generic questions, which why not get into them and have a chat about them? This is quite specific to, I guess, you and to AirTree. So what are you looking for when investing in a startup, and is a technical co-founder always needed? Broad question, but...
Let me answer the second question first. I think that we get this a lot, especially when we're doing sort of early stage office hours. To be honest, I think it is. It doesn't have to be, a tech co-founder doesn't have to be there from the beginning, but if you're a tech business, you need someone who feels like an owner, who is able to build products. And I think oftentimes you'll find yourself as a non-technical expert to begin with a really, really good insight into a market problem or a market failure. And that's a huge benefit for the startup. In fact, one of the key things we look for is someone who has that sort of earned secret about a particular market. But one of the first things you're ever going to have to do is convince some team members to join you and buy into that vision. And that's way harder than convincing any VC to invest in the vision, because you're asking someone to give up their career capital, their time, and really engage long-term as a potential co-founder of their business. And so not only do I think it's necessary because you need to eventually go out and build a product and you need to have those people there, but it's also a great litmus test as to can you get out there and sell the vision. And if you can't do that, I would keep practicing until you can, because that's, every founder needs to have conviction in their own vision. And the best way to build conviction in their own vision is to be able to convince really talented people to join you on that vision. It's a great test as a leader, and it's a great test of your own conviction. So I think so, yes. That's the second bit. The first question is what are we looking for? I mean, we as I said at the top, we invest right across the board. We want to find ambitious founders who are working in just about any sort of digital technology focused sector. So it's pretty broad. I think the things that we try and identify are founders that are outliers on some dimension, and this is the trickiest part of our job, is that we're sort of, it's almost like a recruitment agent for sort of superpowers. Everyone has a different superpower, and I think that's what we're trying to identify, and why we love to spend so much time, on face-to-face or these days on Zoom with founders as part of the process, is to try and get to know them personally, what drives them, what chips they have on their shoulder that they're trying to prove out, what really motivates them, and what is their sort of outlier skill set. Are they outliers because they have a particular insight into a industry because they've worked in it for so long? Are they outliers because they have some sort of incredible technical capability in a particular area? Are they outliers just because of the sort of people that have enough grit that they'd walk through plate sheets of glass to get to their outcome? They're almost all cases where we invest. there is some sort of dynamic in which they are an outlier on some sort of aspect. So beyond that, it can be just about anything. I think the market and the problem that they have to be going after needs to be large. But for the most part, the founders that get really excited about those problem sets are the ones going after really big markets and really big problems.
Yeah, cool. And another sort of broad one, I guess, more VC related, but I could talk about AirTree specifically if you feel like it. What's the sort of average success rate? What are you kind of looking for in terms of investing? Obviously, a lot of investments will fail. Like, what's the sort of, how does that look?
Yeah, so I think actually there's a lot of really interesting data on this around the people trying to demonstrate just what an exponential curve on a fund portfolio distribution looks like. And it's all pretty consistent. It's almost all exponential across all the studies that have been done in venture. No matter how much you try and game it so that you don't have losses in the portfolio, you are always going to have losses in the portfolio. And in almost all cases, it follows the same general shape of curve, which is, typically in a portfolio of 10 companies, you might have one or two that, for a successful fund, one or two that are, 5 to 15 or 20 times returns, and you'll have a group of 5 or 6 that go return sort of 1 times or a little more, and then there'll be a group in the middle which is sort of 3 to 5x. And so really if you don't have those large outsized returns in the portfolio, it is difficult to, on an aggregate, on a portfolio construction basis, return a good IRR to your investors. Which is why VCs are obsessed with these large markets, large outcomes, etc. It's because so many of the businesses that we do invest won't achieve that, so we have to have ones that do get there so that they can balance the risk. And that's why in the cases we have to say no to a lot of fantastic businesses that are going to do very, very well, but they just don't have the risk return profile that makes sense in a VC portfolio.
Yeah, no, for sure. I've got a specific one about buy now, pay later. So the Afterpay share price has made a remarkable recovery from March. What's your view on the future of success in the buy now, pay later market as consumers look for more flexible payment options coming out of COVID-19?
Yeah, I think the value in Afterpay is not the fact that they're buy now, pay later. I think you've seen from the market there are lots and lots of buy now, pay later sort of effective businesses out there that are moving into what used to be the domain of the pure play lenders. I think the real benefit from a company like Afterpay is that they are able to bring a consumer base to a vendor, and they've been able to do that in from such a position of category leadership that people genuinely do look to find vendors that are linked up with Afterpay before they make a buying decision, and that's incredibly powerful if you can get there. Buy now, pay later is nothing new, but they've been able to do a terrific job of that. They've also, the huge spike recently in the prices largely around the Tencent investment with the Asia angle that it brings with it, and I think that's probably too heavily priced into the price at the moment. But there are, these are the market opportunities that VCs only dream about. And if I was one of the many VCs that passed on Afterpay at $30 million when it was doing an inside private investment round before they went public, I would be sort of shooting myself in the foot right now, because it was, I think what a lot of people missed at that point was that, it was before it had a network effect and before it had a category leadership position, it was trying to convince a bunch of merchants to install a widget on their payment page so that one day they might be able to get some more customers. And they didn't have that network effect. They were able to do that with a terrific effect over the next sort of several years in Australia, and we've been able to show that the same playbook works in the US. And so I'm very bullish on the business itself. There's all sorts of regulatory challenges that they have, but they, for my mind, will be able to deal with most of them.
Yeah. Okay. Good. Conscious of time, I think we've got till 2, but you know, everyone's busy at the moment. So look, unless there's any other questions, I think we'll start wrapping up. You know, one thing I want to mention before we kind of close off, obviously at LegalVision we assist lots and lots of startups. So we probably do more startup capital raises than any firm in Australia now. So if you're a founder, you're raising at the moment, and you need help, definitely get in touch. If you're sort of in an earlier stage, or actually you're more of a kind of small business that needs, you know, assistance and legal help, the product that has been really working well through the COVID-19 period that we have is our LV Connect membership, which is very cost effective, $200 a month, and basically entitles you to call up at any time, have a consult with one of our lawyers, get, you know, quick, effective legal advice on the phone. So what we're doing with that is anyone who's been on this webinar, we've got a special offer for you guys. So make sure that when you get the email at the end of the webinar, you respond if you're interested, because we do have that special offer. I won't tell you what it is because this works better if we don't tell you what it is. I don't know, we found that out a couple of weeks ago. So yeah, look, anything we can do to help, please let us know. And I'm sure, James, you know, if you've got, there are founders here that are, you know, want to get in touch, is there some way they can do that? What's the best way of getting in touch with you?
We're pretty open. You can get us on Twitter. You can get us on James at airtree.vc. You know, we try to get out there as much as we can. And the biggest one of the biggest issues we've had over the last couple of weeks is we can't be out and about. We're not at events. We're not sort of out there in person. So we love you know, people emailing us, and don't bother about a warm intro. You know, we love cold intros. So just get in touch. And it's and we'd love to hear from you, because we're actively investing. We've got a lot of dry powder, and we would love to find the next Atlassian coming out of this crisis in the same way it did the last one.
Great. All right. Well, look, thanks heaps for taking the time. Really appreciate it. Very insightful comments. It was super interesting for me to listen to it, and hopefully everyone who's online thinks the same. And we might do it again sometime. So stay tuned. But thanks again, and we'll speak soon.
Pleasure, mate. Thank you. Thanks, everyone.